All right, welcome. Today we're pulling back the curtain on a strategy that pro investors use to get a huge leg up on the market. We're talking about seeing big moves coming weeks, sometimes even months, before anyone else. So let's get right into it. You've probably asked yourself this, right? You see a sector just ignite out of nowhere and you're left wondering, how did they know? Well, here's the thing. It's not a lucky guess, it's not magic, they're just reading a different map. In this, right here, is the fundamental difference. Most investors, maybe you included, are trained to follow the news, to react to headlines, to look at price patterns. The pros? They're on a totally different track. They follow the money, and the footprint of that smart money is volume. Now, to really get why volume is such a game changer, we first have to look at the standard map that most people are handed. This is the classic idea of sector rotation, based on where we are in the economic cycle. You've probably seen this before. The theory is pretty logical, right? When the economy is just starting to recover, you'd expect sectors like tech and financials to do well. Then, as things heat up, industrials take over. And when things cool down, you rotate into safer bets like healthcare. It makes perfect sense, on paper. But here's the secret the pros know. This classic map? It's just a rough guide. It's not a set of ironclad rules. Today's markets are way too fast and complex for that. So the real question becomes, how do you validate it? How do you know what's actually happening? And that brings us to the professional's secret weapon. Instead of just guessing about the economy, they look for cold, hard evidence. They track where the big institutions, the smart money, are actually placing their bets. And they do that by decoding volume. This entire approach really rests on three key ideas. Let's call them the three pillars of volume analysis. These are the signals that tell them what's happening behind the curtain. Pillar number one is about spotting accumulation versus distribution. It's simple but powerful. When you see prices rising and the volume is just exploding, that's big money quietly buying things up. But, and this is a big but, if you see prices creeping up on really weak, pathetic volume, that's a huge red flag. It could mean they're sneaking out the back door. Pillar two is something called a volume climax. This is when trading activity goes absolutely nuts, a huge spike way above normal. It's pure emotion. It often marks the exact point where everyone else gets swept up in euphoria or panic. For a pro, that's a signal that the party's about to end and a reversal is coming. Okay, so what happens when things get tricky? What if the price is hitting new highs? Everything looks great on the surface, but the volume is actually getting weaker and weaker. What does that mean? That, my friends, is called divergence, and this is pillar number three. The professional's golden rule is simple. When price and volume are telling you two different stories, you listen to the volume, every time. A rally without volume is a rally without conviction. It's a house of cards. So that's the theory. It sounds great, but let's get practical. How does a professional actually use this stuff day in and day out to make real-world decisions? They use tools that look a lot like this. This is a live momentum scanner, and I want you to notice something crucial. It's not just ranking sectors on price. Look at that third column, the key volume signal. It's showing things like, is volume 150% above its average? This tells you, in real time, exactly where the big money is flowing. And to see just how powerful this is, let's look at a perfect example. Remember that massive boom in the IT sector back in 2023? It seemed to come out of nowhere and caught so many people flat-footed. Well, it really shouldn't have. Just look at this. That big price breakout is what made the news. But the real story? The massive expansion in volume started a full 2 weeks before the price took off. The institutions were loading up the truck while no one was watching. The signal was clear as day. And the result of catching that early signal? Investors who were following the volume were positioned for a staggering 25 to 40% outperformance over the broader market. I mean, think about that. That's the difference between a good year and a life-changing one. So here's the really crucial takeaway from that. Volume isn't just confirming what's already happening. It's a leading indicator. The big money moves in months, sometimes 3 to 6 months, before the good news hits the headlines. The accumulation was the story. Okay, so let's boil all this down. If you're going to take one thing away from this, one new way of looking at the market, what should it be? It's this. It's a new mental model. Stop just asking, is the price going up, and start asking a better question. Is there real conviction behind this move? Volume is how you measure that conviction. It's the difference between a real trend and just market noise. So to wrap it all up, it comes down to three simple rules. Rising prices with rising volume? That's a green light. That's institutional buying. Rising prices on fading, weak volume? That's a huge red flag. Demand is drying up.
And third, when you're in doubt, when things feel weird, always trust what the volume is telling you.
And that leaves us with one final thought to take with you. This data isn't hidden away in some secret vault. It's out there for all of us to see. So, if volume really is the language of the market, revealing its true intentions, what's it telling you today?